Good afternoon. This is Dominic at Hargreaves Lansdowne. Thank you for joining us and logging in for today's webinar, where we'll be talking about the lifetime allowance. You may have heard from me previously, as we ran a whole series of webinars similar to this one on topics that we find quite a few of our clients have questions on back towards the start of this year. We took a lot of feedback from that, and we had quite a few questions on different topics that we hadn't yet covered. So we're using this week as an opportunity to cover off those topics and hopefully bring you a lot more information that could be of use. The webinar itself, I would say, probably lasts around about 20 minutes or so. We'll be providing a lot of information, but it will be just that. It's information as opposed to financial advice. If you do want advice on any of the topics that we cover this week, then please do speak to a financial advisor to find out more about that. We'll make a start in terms of what we're looking to cover today. It's mainly focused on the lifetime allowance. Now, this is something that I think most of the questions that we had in our last series were in regard to the lifetime allowance and the implications that it has. There's been quite a few changes over the years. So what we'll look at is, what is the lifetime allowance? How has it got to the level that it's at the moment, and what's perhaps the history behind it? We'll have a look then at how it is measured, and if you are affected by the lifetime allowance, what kind of implications that might have. Now, some of you might not know what a lifetime allowance is at all, or you might have some idea, but you might know that it has kind of decreased over time. So those allowances have become a bit more stricter, a bit more restricted. And as such, there are levels of protection which are available for some people. So we'll go through those and explain what kind of options there might be out there. And then one addition that we have with these webinars is that we'll run through a few examples. As I say, it is all information as opposed to financial advice, because the reality is I'm sitting here, I don't know your individual circumstances. So it's really important that you bear that in mind, that any examples that we look at are very general and are for information purposes only. And the crux, the reason for that is that your circumstances are completely unique. So this is based on current rules as it stands. We're working on the 2021 tax year. So if you are kind of watching this online somewhere in what is now the distant future, then bear that in mind, that it's specific to the 2021 tax year and financial rules, that the tax rules can and do change on a fairly regular basis. So the lifetime allowance was introduced on the 6th of April 2006, but it's not remained at the same level that it was when it was set at that point. It's been as high as 1.8 million and as low as 1 million, which was only a couple of years ago, actually. It now sits at a nice round figure of 1.073100 million. So it's essentially, the reason that it's that kind of odd figure there is that when it was moved down to 1 million, it was then linked with CPI. So it now has increased in line with CPI for a couple of years or so. And as it stands at the moment, it's still due to rise in line with CPI over time. Now, the lifetime allowance is often described as a limit on the total value of your pensions. But the reality is that there is no limit on the value of your pension savings that you can build up. So a pension member could build up a pension of 3-4 million if they were able to do so. There's nothing stopping them doing so. But actually, if your pensions exceed the lifetime allowance when they're measured, and we'll come on to when it is they're measured and how shortly, if they are above the lifetime allowance at that point, the excess above that figure could be subject to a tax charge known as the lifetime allowance charge. So it's not a cap. It's not that you hit a ceiling and you can't get anything else into the pension. It's just that anything above that could be taxed quite substantially. And as you can see there, it could be taxed as high as 55% in some cases. I would note on this as well, it's worth noting that your state pension is not part of the lifetime allowance kind of realm. So your state pension isn't usually measured against your lifetime allowance, so you can discount that. You're only really looking at your personal and workplace pensions, whether it's defined contribution or defined benefit. You may still need to take all of those into account when you're accessing your funds or when you're considering the lifetime allowance. But to show you the changes over the years here, you can see, as we said, the 6th of April 2006 is when the lifetime allowance was introduced. You can see there's a kind of steady movement up until April 2010 when it hits 1.8 million. It stays there for a couple of years, and then you can see that gradual process of it dropping back down to 1 million in 2016-17. From 17-18, it has been rising in line with CPI, which explains the odd figures that you can see for the last 3 years. Some people may have been affected when the lifetime allowance kind of dropped, but there was transitional rules brought in or protection made available in each of those cases. So when it dropped from 1.8 to 1.5, and when it dropped from 1.5 to 1.25, there was a different levels of protection available. And that's something that we will talk briefly about, but it's always worthwhile looking at that. If you do feel like you'd be affected by the lifetime allowance as it stands, there may be avenues that you can investigate further to get more information and a bit more assistance with that. So we'll look at when measurements are made, then how they're made, as this will vary depending on the pension schemes that you hold. So firstly, if we look at the when, whenever you take benefits from a pension, you use up a percentage of the lifetime allowance, and this is called a benefit crystallization event. So you may see it called a BCE to give it its kind of acronym and its jargon that's usually used. There's quite a few different examples here, but firstly, if you use your pension fund to buy an annuity, if you move it into drawdown, or you take an enough plus, which is an uncrystallized fund pension lump sum, before the age of 75, then the value of the fund that you've used to do that will be measured against the lifetime allowance as a percentage. If you start to receive benefits from a final salary scheme before age 75, then that will be a benefit crystallization event as well. Actually reaching age 75 itself is a benefit crystallization event. So if you haven't accessed any of your pensions and you don't plan to, but you reach age 75, whatever you have there will be measured against the lifetime allowance. You don't necessarily have to take any of your pension at 75. That's not the case any longer. It's just that it will be measured for lifetime allowance purposes as that day. If you pass away before age 75 and you have pensions that have not been accessed, then they will be measured at that time. Also, if you transfer your pension to a cure-ops before age 75. Now, a cure-ops is a qualifying, recognised overseas pension scheme. So if you do move your pension abroad, you can't escape the lifetime allowance by doing so. It will be measured as part of that process of moving to a cure-ops scheme in another country. If you have any excessive increases on a scheme pension that's in payment, in terms of what's excessive, it can vary. So it's always worthwhile speaking to the provider of your scheme pension to understand the ins and outs of the rules that are set for them there and find out more information about that. And also various one-off payments from pension schemes can also be considered and measured against the lifetime allowance as and when they're received. The last one to mention here, I mean, there may be others that are out there as well, so it's always worthwhile being vigilant and investigating further. But if you reach age 75 with funds already in drawdown, so the first point we looked at here was moving into drawdown was a benefit crystallization event. But if you reach 75 and you still have funds in drawdown, the value at 75 will be compared with what was moved into drawdown. And if it has grown, then that growth will be measured against the lifetime allowance. So it's not kind of double measured, if you like. It's not kind of doubling up. It's just measuring the difference. Hopefully that makes sense. Now, how your pot is measured also depends on a few different factors. So for a money purchase pension, sometimes called defined contribution, so a pension scheme that you've been kind of making contributions to, or your employer has been making kind of contributions to on your behalf, it's the value of the pot as a percentage at the time that you access the pension, or at age 75, or upon your death, whichever kind of BCE, benefit crystallization event, comes first. It's the total value of the pot measured against the lifetime allowance at that time. So for example, if you had a money purchase pension pot which was worth 107,310, which you take benefits from in the current tax year, 2021, that's 10% of the current lifetime allowance. So if you accessed a pot of that value, you'd get a certificate saying that you've taken 10% of the lifetime allowance. As it stands, later on down the line, you might access other pensions, and that will be measured against whatever the lifetime allowance is at that time, but you'll still have the 10% certificate to say you've used that up, whatever the lifetime allowance moves to. If you have a final salary pension that's not in payment, a good kind of rule of thumb is to consider how much it would pay you per year and multiply that by 20. That will give you a figure that you measure against the lifetime allowance, but you will also need to account for the tax-free cash that you may be receiving. So it's not just the annual income, but also the lump sum that you may receive as a kind of as you start drawing on that. If pensions taken since the 5th of April 2006, it's a percentage stated by the pension provider. So as we've just said, whenever you access your pension, you should be provided with a certificate indicating how much you've used up. And that percentage will not change. That remains the same regardless of what happens to the lifetime allowance under current rules. If you have pensions taken before the 5th of April 2006, they're usually not measured until you take benefits after 2006. But when they are measured, they would be measured at 25 times their annual pension. So the reason it's 25 rather than 20 times the annual pension is because it doesn't account for any tax-free cash that you've received. So that's an attempt to kind of cover any lump sums that you might have received as well. But usually pensions taken before the 5th of April 2006 wouldn't be measured until you access pensions after 2006 as well. So in terms of the lifetime allowance tax charge, we've had a look at when and how it might be measured, but the tax implications here, there's usually two options that are available to you. Sometimes you may not have the option, depending on the type of pension scheme, but it depends on how you access it usually. Now, option one is to take the excess amount above the lifetime allowance as a lump sum. So you take it all out in one go. So if the lifetime allowance is just over 1 million, but your pot is 1.2, well, that 200,000 or so, you could take it all out as one lump sum. You can see here that there will be a lifetime allowance charge of 55% on that figure. Then the residual 45% is paid to you, the individual, the member, and that's only available before age 75. So 55% is paid straight off, the remaining 45% is paid to you, and that's it for the lifetime allowance tax charge and so on. The alternative option, if you don't want to take a lump sum, is to take the residual amount as an income. So this might be, for example, if you're moving a pension into drawdown, and that pension is worth more than the lifetime allowance. Well, again, if we use that example again of a 1.2 million pension pot, you might say, well, I want to move it into drawdown. So you would move the 200,000 or so that's above the lifetime allowance into a drawdown account. But before doing that, a lifetime allowance charge of 25% is deducted rather than the 55. The other thing to consider here is it's not like the previous example where you just get the remaining 75% tax-free. Anything you draw from that 75% could be taxed at your income rate, so at your highest marginal rate. So it's not just the 25% to consider, but the fact that anything else you draw from it will be taxable, whereas that's not the case with the lump sum option. So there is a bit to think about there, depending on how much you want to withdraw, your personal tax circumstances and so on. If you're ever unsure on what to do, then do seek personal financial advice so that an advisor can assist you with that. So what happens then? We've seen that the lifetime allowance has dropped over time, but what levels of protection are currently available? We've got two examples here. There is, well, whenever there's been a drop, there's been usually two types: fixed and individual protection. Though of course there are quite a few others out there. Fixed protection in 2016 fixes your lifetime allowance at the 1.25 million, and in 2016 this was when it dropped from 1.25 to 1 million. So you could apply for fixed protection, which leaves your lifetime allowance untouched at the 1.25. But you can only qualify for this if no benefits have been accrued since the 6th of April 2016. So this means you haven't made any contributions into your personal pensions or your workplace pensions, and that also includes employer contributions as well. It also includes, if you have a final salary scheme, building up further benefits within that. So the broad majority of people would tend to have contributed to their pension over the last 4 years if they're still working and so on. So actually it may not be something that's applicable for a few of you, though some of you it may apply to. If you already hold individual protection, 2014 or 2016, the years in which the lifetime allowance dropped, you're unable to apply for fixed protection. It is also possible to lose fixed protection. So if you do accrue any further benefits, then the lifetime allowance would revert to the 1.073100 that we have in place at the moment. Now, individual protection is a little bit different. It fixes your lifetime allowance at the value of your pensions as of the 5th of April 2016, with a maximum of 1.25 million. So if you had 1.1 million on the 5th of April 2016, you can request a statement from your pension provider. They would give that to you. And your lifetime allowance will be fixed at that level, at that 1.1. But the benefit here is you could still make contributions to your pensions without invalidating your individual protection. So this really comes into use if, let's say, you had it at 1.1 million on the 5th of April 2016, you see a stock market crash and your pension drops, you could still fund that. You could still make contributions to try and get that figure back up to your individual lifetime allowance. So you'll only actually qualify for individual protection 2016 if your pensions were worth more than 1 million in total as of the 5th of April 2016. The reality is, if they weren't, then the lifetime allowance is still above that level anyway. So you can not also hold primary protection or individual protection 2014. Now, we're looking at these very basically, but actually there may be a few others which you might want to investigate further. You might already hold protection and want to know more about that. We do have a guide on our website available for the lifetime allowance guide, which outlines the different levels of protection, how you qualify, and the mechanics of that. So really worthwhile checking that out if you do want any more detail. So what we'll do now, we've given the kind of the foundations there of knowledge around lifetime allowance and when and how it's calculated and what protection might be available. We can now run through a few basic examples. Please note that, of course, this is not personal financial advice. We do have an award-winning financial advice team who can provide specific and holistic financial advice if that's required. So do take that into account. But yeah, generally speaking, we're just going to show you the mechanics of how this might work. So in the first instance, we'll take the example of a defined contribution pension, where this individual wants to take their pension in the current tax year, where you can see there the lifetime allowance is 1,073,100. So the pension pot for this individual is currently 1.25 million. That's the kind of level that they've grown their pensions to across their working life, and they're now ready to access that pot. This individual has said they want to take the maximum tax-free cash and move the rest into drawdown, which indicates they want to take an income. So what we need to do here is we can see that their pension pot is above the value of the lifetime allowance. It's in excess by 176,900, and that's in excess of the lifetime allowance. This is what we need to work out the tax on. So as it's going to be moved into drawdown, it will be taken over time. The tax charge, you work this out by taking that, the excess lifetime allowance tax charge of 25% on income, and apply that to the excess, which gives you a tax charge of £44,225. And that is usually paid from within the pension. So that's taken from the excess and given to the taxman. And then to work out the tax-free cash, it's worth discussing this because actually you can only receive, when you're working out the tax-free cash, it's 25% of the total value of your pension or of the lifetime allowance, whichever is the lowest. So in this case, the lifetime allowance is lower than the value of the pension. So the maximum tax-free cash that can be taken is 25% of the lifetime allowance. So you can see that in the green box there, which indicates this individual is taking £268,000 as a tax-free lump sum. That represents their 25%, but it's 25% of the lifetime allowance. So they get 268,000 tax-free. The remaining 937,000 is moved into drawdown. Now that 937 is made up of the residual 132,000 once we've taken away the £44,000 tax for the excess, and the remaining 804,000 that is after the tax-free cash when you're looking at the lifetime allowance and the pension. And then future withdrawals from the account here, from the £937,000 in drawdown, will be subject to this individual's income tax band, whatever that might be. It's not always the case that you'll take your pension in one go, and it might be the case that you take it over a number of different years. You have multiple different benefit crystallization events, and in that time, the lifetime allowance may well have changed. So we'll look at another example here. Again, a defined contribution pension, and the first instance, this individual takes their sum of their pension is in 2013-14, which is when the lifetime allowance was 1.5 million. So you can see here this individual's pension pot is 1.6 million, which of course is over the lifetime allowance. Now they want to access £1 million in this example, which is within the lifetime allowance. They don't want to take the full 1.6. They've chosen to take £1 million, which represents 66.66% of the then lifetime allowance. So as part of that process, they take that as a lump sum. They've used 66% of their lifetime allowance. It's down to their pension provider to provide them with a nice little certificate that you can see there, which shows them, well, you have used 66% of your lifetime allowance. Now, if we fast forward to the current tax year, 2021, with a much lower lifetime allowance, the pension may have grown. So the residual amount that was left, they took £1 million, they've left 600,000. Let's imagine that's grown back to 700,000. Though of course that's not always guaranteed at all with a pension. The value can indeed fluctuate, and it will do. They now want to access the whole lot in one lump sum via the uncrystallised fund pension lump sum method, so an UF plus method, where 25% is tax-free and the residual amount is withdrawn and taxed at that point. So essentially they just want to take the whole lot as a lump sum. Now this person only has 33.34% of their remaining lifetime allowance, and notice that it's not adjusted because the lifetime allowance has dropped. It's deemed that the access in 2013-14 use up 66% of the lifetime allowance. You just apply that 66% to the current lifetime allowance to understand what you have left, and in this case it's 33.34%, which indicates only 357,000 as a remaining lifetime allowance. So if the client takes £700,000 as a lump sum, this leads to an excess above the lifetime allowance. You can see here of £342,000 excess. Because this individual has chosen to take it as a lump sum, they will pay an excess tax charge of 55% as opposed to the 25% followed by income tax. So it'll just be the 55%. So when we work this out here, we've got the excess times the charge, which gives you a lifetime allowance tax charge of £188,000. And the tax charge is rounded down to the nearest pound as well, which is worth noting. Before we wrap up there and provide you with a few useful details, the last thing we'll look at is the defined benefit pensions. We don't tend to talk about them too much, as really it's something that you would speak to a defined benefit provider or your pension provider about to find out a lot more. Though we've got quite a useful example here to show you how this would work. Now in this example, for this person's defined benefit pension, they speak to their pension provider, they want to access it, they're ready to do so, and they indicate that they would be receiving £50,000 per year from their final salary scheme with a lump sum payment, tax-free cash of £250,000. Now, if we remember back to when we had a look at how the lifetime allowance was measured, when we looked at defined benefit schemes, we needed to multiply the income per year by a factor. So the final salary scheme currently pays £50,000 per year with a tax-free cash lump sum of £250,000. We need to multiply the £50,000 by 20. So we're multiplying that income by 20, which gives us £1 million. We then add on the tax-free cash, which is £250,000. We can see then that it's about 1.25 million, which is measured against the lifetime allowance, and we can see there's an excess here. Now, what tends to happen is the level of income from the final salary scheme is normally reduced to facilitate the payment of the lifetime allowance tax charge. But the tax charge in this example is 44,000 or so. So what would tend to happen is, rather than the individual having to pay out a lump sum, the amount they would get per year might be a little bit less than 50,000 to compensate the tax charge and have that tax paid out. So I really hope those examples were useful to you. As I say, they are very general, and it's not going to apply to anyone in particular. So really worthwhile carrying out your research and asking questions to those who can help if there is anything you need assistance with. Because we're talking about accessing your pension, I thought it'd be worthwhile highlighting PensionWise, which is the government's free and impartial guidance service. It's for those of you aged over 50 and who are looking at accessing your workplace or personal pension plans. but really the role of PensionWise is to help you understand the different options that are out there. Currently, you can only contact them over the phone. Previously and in future, perhaps they will be able to do face-to-face meetings, but as you can understand, over the phone is the option that's been that they're going with at the moment. You can see the telephone number there, so it's 0800 138 3944, and also check out their website as well for more useful information. We've alluded to quite a few details here, but there is more information to be found, and there is the lifetime allowance fact sheet, which is available through our website. So you can see it's the hl.co.uk website. You can use the search icon in the top right. You can see it on the iPad there, where you can type in lifetime allowance and get all the information that's out there, find the section of the website, use the fact sheet, and understand a bit more about it from there. So please do check that out. So that's about everything that we had planned for today. So please do take the last couple of minutes or so to read through our important investment notes before we wrap up. We do have time for questions. So if there are any queries that you have, please do use the Q&A function along the bottom, and we'll look to answer those. Any other questions that you have, please do check out our website, and there's likely to be the information there. But I'll give you a few minutes to read through the investment notes, and then we'll tackle any questions. Thank you very much. Okay, so thank you for listening, and thank you for taking the time to read through the notes there. If you do have any questions, please do use the function, and we'll look to get those answered. Any questions you have in future, please don't hesitate to check out our website and contact us if there is any queries. Thank you very much, and have a great day.